The Nasdaq 100 isn't just a list of companies, it's a symbol of achievement, a badge of honor reserved for the most influential and groundbreaking non-financial firms on the Nasdaq exchange. To be included is to be recognized as a leader, a company that not only shapes its industry, but also sets the pace for the global economy. These are the organizations that investors, analysts, and the public watch closely, knowing their moves can ripple across markets worldwide. It's a club of titans: Apple, Microsoft, Amazon. Names that have redefined how we live, work, and connect. Their innovations have touched billions, transforming everything from communication to commerce. Inclusion means more than prestige. It brings tangible financial benefits. Funds and ETFs that track the index are required to buy shares, often driving up demand and boosting share prices. For companies, this can mean greater visibility, increased liquidity, and a powerful vote of confidence from the market. Removal, on the other hand, can trigger a rapid sell-off, as funds rebalance and investors react to the loss of status. The stakes are high and the impact is immediate. The index deliberately excludes banks and financial firms, focusing instead on companies driving the new economy: technology, retail, and biotech. These sectors are at the forefront of change, constantly pushing boundaries and redefining what's possible. These are the engines of future growth, the innovators and disruptors that make the Nasdaq 100 a key barometer for global innovation and economic momentum. The criteria for entry are clear: market capitalization and operational success. Only the strongest, most dynamic companies make the cut. Companies must be true leaders, generating real revenue from products and services that impact millions. It's not enough to have a big idea. Execution and scale matter. But now, a new breed of company is testing what it means to be a Nasdaq 100 member, blurring the lines between software provider, digital asset vault, and financial innovator. The landscape is shifting, and the definition of a tech leader is evolving. The question remains: what truly defines a top-tier technology company in the 21st century? As the world changes, so too does the exclusive club at the heart of innovation. MicroStrategy was once a quiet force in the world of business intelligence software, led by the visionary Michael Saylor. For years, the company built its reputation on helping organizations unlock the power of their data, providing tools that enabled businesses to make smarter decisions and stay ahead in a competitive landscape. For decades, MicroStrategy's software empowered analysts and executives alike, turning raw numbers into actionable insights. But in 2020, a seismic shift occurred, one that would redefine the company's future and send shockwaves through the tech and financial worlds. In a move that stunned Wall Street and Silicon Valley alike, MicroStrategy adopted Bitcoin as its primary treasury reserve asset, fundamentally altering its corporate strategy and identity. This wasn't just a minor adjustment, it was a complete transformation. Michael Saylor emerged as a passionate and outspoken advocate for Bitcoin, famously calling it digital gold. He argued that Bitcoin was not only a revolutionary technology, but also a powerful hedge against inflation and currency devaluation. Unlike other companies that merely experimented with cryptocurrencies, MicroStrategy went all in. The company raised billions in capital, using the funds to purchase even more Bitcoin, and in doing so, it transformed both its balance sheet and its public image. MicroStrategy became a corporate proxy for Bitcoin, evolving from a traditional software vendor into a symbol of bold financial innovation and risk-taking in the digital age. By December 2024, the company's market capitalization soared to new heights, earning it a coveted spot in the Nasdaq 100's technology category, a recognition reserved for the most influential tech players. For some investors, this validated MicroStrategy's high-risk, high-reward strategy, inspiring excitement and optimism. For others, it raised serious concerns about volatility and the wisdom of tying a company's fate so closely to a single, unpredictable asset. Now, MicroStrategy found itself sitting among the world's tech giants, not because of its software, but because of its audacious and unprecedented bet on Bitcoin. Its inclusion in the Nasdaq 100 forced the market to reconsider what it truly means to be a top innovator in technology and finance, blurring the lines between software, investment, and the future of digital assets. MicroStrategy's Bitcoin pivot was radical for a public tech company. Most firms keep cash in safe, liquid assets, preserving capital, not chasing big gains. MicroStrategy flipped this script, exposing its treasury to Bitcoin's wild volatility. Saylor argued that cash loses value to inflation, while Bitcoin offers long-term growth. The result? MicroStrategy became two companies in one: legacy software and a massive Bitcoin holding entity. Investors buying MSTR stock are really buying a stake in its Bitcoin, with software now a footnote. This dual identity is unique and controversial, fundamentally changing the risk for shareholders. Instead of betting on software innovation, investors are making a leveraged bet on Bitcoin's future. MicroStrategy, a tech firm by label, now acts more like a specialized investment vehicle. MicroStrategy's stock, known by its ticker MSTR, now moves almost in perfect sync with Bitcoin, the world's leading cryptocurrency. Over the past few years, the company has become famous for its bold strategy of buying and holding massive amounts of Bitcoin, making its stock price closely tied to the digital asset's wild swings. When Bitcoin rises, MSTR often surges even more dramatically. When Bitcoin falls, MSTR tends to drop even harder. This amplified movement is a direct result of the company's leveraged exposure to Bitcoin, which means that MicroStrategy's stock can be even more volatile than Bitcoin itself. This tight link has made MSTR a go-to choice for investors who want exposure to Bitcoin's price action, but prefer to do so through traditional stock markets rather than buying crypto directly. For many, it's a way to participate in the crypto boom using familiar brokerage accounts. The stock's volatility is extreme, often swinging wildly in response to crypto market sentiment rather than the company's actual software business performance. This means that news about Bitcoin can have a bigger impact on MSTR than any product launch or earnings report. For example, on Nasdaq's rebalancing day, a modest 2% dip in Bitcoin's price led to a sharp 3.7% drop in MSTR, showcasing just how much the stock's swings are amplified compared to the underlying asset. Much of this leverage comes from MicroStrategy's strategy of using debt to finance its Bitcoin purchases, which magnifies both the potential gains and the risks of heavy losses. This approach has made the company's financial profile unique among public firms. For investors, traditional metrics like revenue or profit margins matter less and less. Instead, the value of MicroStrategy's Bitcoin holdings is what truly counts when evaluating the company's worth. As a result, MSTR often trades at a premium or discount to the value of its Bitcoin stash, effectively turning the company into a de facto Bitcoin holding company in the eyes of the market. The transformation is so complete that MicroStrategy's original software business now barely registers in its valuation, as investors and analysts focus almost entirely on its massive Bitcoin reserves and the company's ongoing crypto strategy. Every December, the Nasdaq 100 reshuffles, adding and removing companies based on market cap. This year, 6 companies were out, like Lululemon and ON Semiconductor, while 6 new names joined, including biotech and data storage firms. The process is high stakes. Removal triggers fund sell-offs, while inclusion brings a surge of investment. MicroStrategy survived the cut, its market cap still high enough to stay in the club. For its supporters, this was a win. Another year of visibility and institutional demand. But the debate over its business model only intensified. The index's integrity depends on reflecting true innovators, not just market cap leaders. MicroStrategy's continued presence highlights the tension between old rules and new realities. Its place is secure for now, but the reckoning over its long-term fit is far from over. MicroStrategy's spot in the Nasdaq 100 has sparked growing concern among analysts. Critics argue it's no longer a true tech company, but a Bitcoin holding fund in disguise. Its risk profile is far beyond that of a typical software firm, with fortunes tied almost entirely to Bitcoin's price. This creates a backdoor for index funds to gain crypto exposure, whether investors want it or not. Index providers face a dilemma. MicroStrategy meets the numbers, but does it fit the spirit of the index? Including such companies could dilute the index's purpose and mislead investors seeking diversified tech exposure. The debate is forcing a hard look at whether the rules need to change for the digital asset era. MicroStrategy's case has ignited a bigger debate. Where do digital asset-heavy companies fit in the market? These firms don't match traditional industry categories, challenging index providers to rethink their classifications. Some argue for inclusion. If a company is public, big, and liquid, it belongs in the index. Others say these are more like commodity funds than operating businesses, and shouldn't be mixed with tech leaders. Including them could distort index performance and mislead investors seeking diversified exposure. The solution? Some propose creating specialized indices for digital asset companies. The market is at a crossroads, and the answer will shape how investors access the crypto economy. The MicroStrategy debate isn't isolated. Major index providers like MSCI are wrestling with the same questions. MSCI is considering excluding companies whose main activity is holding digital assets from its equity benchmarks. Their upcoming decision could set a powerful precedent, pressuring others like Nasdaq to follow suit. If MSCI excludes digital asset companies, Nasdaq may be forced to rethink its own rules. Conversely, continued inclusion would legitimize MicroStrategy's place and signal that indices must evolve. The outcome, expected soon, will shape how digital asset companies are treated in mainstream benchmarks. The stakes are high, not just for MicroStrategy, but for the future of market indexing itself. As of December 2025, MicroStrategy remains in the Nasdaq 100, its market cap buoyed by Bitcoin. For now, it enjoys the benefits of prestige and institutional investment. But its future is precarious, hinging on two forces: Bitcoin's price and the evolving stance of index providers. A crypto downturn could knock it out on market cap alone. More critically, a rule change could reclassify it as an investment fund, making it ineligible for the index. The coming year will be decisive. Will Bitcoin's value hold, and will index gatekeepers redraw the boundaries? MicroStrategy's journey blurs the line between tech and finance, symbolizing the disruptive power of digital assets. Its place in the big leagues is anything but guaranteed, with its fate tied to both the crypto market and the decisions of financial gatekeepers.